We're often asked, how do I determine what a piece of real estate is worth? And we're talking investment purchases here. Unlike if I'm buying a house to live in where I really want to live in that neighborhood or near that church or that school. When it comes to investment property, I'm buying a business and I'm going to pay based on what it will produce. We use a formula we call the capitalization rate, or cap rate for short. The brief definition is a cap rate is a return on investment if we could pay cash for the property. We know that real estate makes us money in other ways. It may go up in value 2%. It may help us build wealth by shielding some of our income tax. But a capitalization rate is the thing we want to factor into our decision making and our purchase price. We can't count on appreciation. What we can and need to count on is how much rent's going to come in off the property. A key term to calculating the cap rate is true net income, as opposed to gross income. Rents for $1,000 a month, that's $12,000 a year. We need to know how much is left after we take away the taxes, the insurance, the HOA dues, and all the other expenses, our allowance for vacancy, our allowance for maintenance and repair. How many net dollars will come in 12 months off of this property? And then what is my desired rate? So if I'm looking for an 8% capitalization rate, and think savings account at the bank or a CD where you get 2 or 3% rate of return, same deal here. If I'm looking for 8%, I'm looking for 8% return like I would on my CD. If I felt like my net income for the year is $8,000 and I'm looking for an 8% return, 8% cap rate, then I can pay $100,000 for the property. The math is not that complicated. Once we calculate what we expect the net income to be, and once we've determined what our desired rate of return is, we would simply divide that net income by that rate of return, and it would give us the value of the property. We use the same process in later years to determine our return on equity. All topics we'll discuss more in future sessions. Thanks for joining us.